and welcome. Thank you everyone for joining us. Today we have a presentation from two of our subject matter experts here at SCA. We'll be covering some important trends in mortgage lending, specifically in the areas of servicing and compliance. And we hope to help you avoid some common pitfalls and maximize your efficiency and effectiveness in these areas amidst the lending environment of today and in the near future. So presenting first today will be Heather Papaus, a consultant specializing in managing secondary market and loan servicing functions. She has many years of experience working in community banks before joining us at SCA. And secondly, we'll hear from Rob Ellis, who is one of our compliance experts with a background at the regulators and who maintains an exhaustive knowledge of the current regulatory environment and systems, LOS and otherwise, that mortgage originators utilize. And just to quickly introduce Spillane Consulting Associates, for the past 30 years, we've provided consulting services to the mortgage industry in the areas of QC, systems and technology, loan manufacturing, secondary marketing, due diligence and compliance, and much more. Our goal is to establish long-lasting relationships with our clients and continue to help them strengthen their operations in an ever-changing market. Over the years, we've become adept at reconfiguring and adding new services through either recruiting top talent or reallocating the experts we have on staff in order to make sure that we're providing exactly the services that our lenders need in any given market. So with that being said, in the current market, we're seeing some interesting trends in servicing and compliance. The first being some loan servicing operational trends and opportunities. And with that, I will pass it off to Heather to take it away.
Great. Thank you, Sean. So I'd like to start out today by talking a little bit about what the current interest rate environment really looks like from a loan servicing perspective. You know, I think we can all agree that the last couple of years have really been unprecedented. The burden that the global pandemic placed on individuals and families and businesses had such an obvious impact on lending with regard to interest rates and housing costs and, more directly on loan servicing practices, the rollout of PPP loans and those COVID-related hardship deferrals and modifications, and then all of the reporting requirements that came along with it. Now, just in the last few months alone, we've seen these sharp rises in the Fed rates with the expectation that even more increases are coming our way at a rapid pace. And this is something that's really, quite historic for most of us to be witnessing. So as a result, what we're seeing is now this dramatic slowdown in residential lending. Mass Bankers Association recently published a news article predicting that the overall mortgage origination totals for this year will see a 36% decline. Now, that being said, financial institutions are all going to be fighting even harder to grab their share of the market, and you might find yourself servicing loans in new geographic locations or targeting new demographics, which has a direct impact on your servicing practices. With the numerous servicing operational assessments that we've completed this year, one of the biggest missteps that I've been witnessing repeatedly is with the front end origination group not communicating with the back end servicing team to collaborate and discuss before rolling out new products and services. If you're serving a new city or town, the loan servicing team needs to consider the setup on the core, the setup of integration and the interfaces, and the expanded needs of managing these additional accounts for disbursement. We're constantly running into situations where the origination team set up a new product on the LOS, but it was never run through the proper channels to ensure that the servicing system could even accommodate the needs of it. Is the core even capable of servicing the loan as intended in the product offering? These types of issues can really get you in quite a mess if the servicing team doesn't have the capability to handle it properly. Currently, we're seeing this reemergence of adjustable rate products, which is, again, something that many of us have not prevalently seen around in some time. So who's checking that the parameters are set up correctly? Who is validating that the notices are up to date? Your loan servicing staff might have some discomfort with handling these responsibilities if they haven't had to focus on something like this in a while. So it's important to ask yourself, are they equipped with the right job aids and training to manage all of this? Do they know what the proper initial and annual ARM notifications should look like? Are they updating the index values in all of the systems? And really are the controls in place and working to ensure that this is all done without a flaw? If these types of questions are not addressed head on, your staff will find themselves spinning their wheels looking for answers. And that can lead to a scenario where either something gets overlooked and it's missed, or it gets done, but maybe not in the most efficient way. The unfortunate story that we continue to see is that with all of the demands of servicing, team members are feeling overwhelmed and they just don't have enough resources or time to address their problems. So their temporary solution is to create a workaround. But then the root cause is never addressed and another person learns that workaround. And now your temporary solution becomes the normal business practice instead of the exception. And as more and more workarounds are present, your team and the integration of everyone's individual parts starts to unravel and the strength of your core moves further and further away from where you want to be. So part of what we like to address when working with a client is removing these workarounds, setting you up with the proper procedures, and training the staff on how to attain a more optimal workflow while not compromising on accuracy. So with the slowing volume numbers, loan servicing team members are presented with this long-awaited opportunity to catch their breath and refocus their efforts on some cleanup and housekeeping items. You might consider reviewing your third-party services that you're using, such as tax and insurance servicing. You might be looking for opportunities of further optimization with them. Your ultimate goal is, of course, ensuring that as much of the process is as automated as possible. You should be looking at the operational pain points of your staff to determine if there is a more efficient way of doing things. Are you utilizing all of the services included in your contract with the vendor? Or do you even know that there have been enhancements to offerings? For example, CoreLogic recently rolled out to their basic tax service agreements to include a delinquency management program. Many clients weren't even aware of this enhancement at all that could drastically save time on the generation of tax delinquency notices. It's also important to take this opportunity to conduct internal reviews and scrubs in areas where we're seeing a lot of regulatory focus right now. Regulators are understanding that financial institutions were really put in the hot seat when it came to rolling out COVID relief offerings. But they also know that there's been a good amount of time elapsed to tweak your process along the way, and all of the clarifications have been made to solidify the requirements for meeting these needs. So they're expecting that by the time they review these loans, you've already identified and corrected any mishaps. They're looking for clear and detailed tracking of your communications with customers that faced a hardship in such a way that they'll be able to clearly recognize the timeline and the steps taken. They're expecting concise written procedures that correlate with what you did and how your servicing system recorded the accounting side of the transaction for the deferred amounts. They'll want to see that you're properly reconciling the outstandings on a monthly basis. And they'll certainly want to see how it's all documented for the customer, both from the language in the original agreements to how it presents itself on the monthly bills. If you encountered an issue after everything was posted and complete with, say, the deferred amounts appearing on a bill incorrectly, they'll want to see what you did to clarify or resolve this for your customers. How you respond to mistakes or shortcomings before it becomes a finding can steer your audit results in one way or another. Another thing that they'll likely be looking at is from a credit reporting and flood management perspective. Are you confident that your credit reporting practices abided by the CARES Act requirement to report the loan status prior to entering a forbearance or deferral? Did you review the flood status of these modified loans? We're seeing multiple clients that missed the mark on many of these things. And what's great is that with the reviews we conducted, we were able to identify it and set them up with an action plan for rectifying it before it became a finding, which presents itself in a much more appealing way to an auditor. GSE audits are also making their way back into the front seat as of late. We're seeing more and more of our clients facing audits coming in from Fannie and Freddie. They're taking a look at the process and your procedures of your monthly reconciliations. They're reviewing that proper controls are in place to maintain your cash position with them. And the overwhelming results are that many servicing teams aren't currently performing up to par. What it's really doing is bringing to light that many institutions weren't even aware that their reconciliation process was not being completed correctly. And the common denominator here has been a lack of proper training and procedure documents to guide them on what to do and how to correct these discrepancies. Instead, the issues were compounded year over year, and now they require a lot of research to resolve them. And really, if no one's been looking at the process with scrutiny, you might be assuming that things are in a better position than reality too. So as a result of these GSE audits and their findings, we're seeing the investors putting their servicers on action plans where they require remediation in the weak areas of performance. Many of these translate to enhancing their procedure documents, affirming that proper training of staff will be completed, and rectifying the portfolio variances with detailed explanations of the root cause and your plan for resolution. As many of you already know, managing the endless list of tasks in a loan servicing operation can be exhausting. But when you add in a remediation plan as a result of unfavorable audit findings, finding the time to focus on addressing these needs can be overwhelmingly daunting. Allowing yourself the opportunity to have a fresh set of eyes that can focus just on these particular needs can really help alleviate the strain on your staff. It can help prevent further errors from occurring, and it really can shorten the timeline to attaining proper resolution. Another area that I want to touch on is in regard to the challenges of finding and retaining qualified servicing talent. Again, we've seen these historic shifts in employment, which is making it very challenging for financial institutions. Many of you very quickly moved from a full in-office environment to full remote, and now you might be operating in some sort of a hybrid model. We saw folks walking away from their jobs for a multitude of reasons, some personal, some medical, others perhaps just taking the opportunity for a change. But regardless, we're now faced with an even smaller pool of candidates in loan servicing. Whether you're looking to expand your team to offset the growing needs and demands, or you're looking to fill an existing vacancy, the challenge is really on. Some senior management might be considering the exploration of alternative fulfillment services like subservicing or outsourcing, but of course, servicing managers aren't keen on being forced into those types of considerations. We've helped clients decipher what is the best fit for them, exploring the costs and benefits of every option, and then guiding them on what they need to do to get where they want to be. Take a fresh look at your job descriptions. Take a look at the functionality of each role. Can it be performed remotely? Would you be able to consider offering a position to someone who would never even step foot in the office? Does your institution have the technologies in place to support this type of dynamic? It really could allow you to expand your talent pool where you remove the commute factor from consideration and you really get to focus on finding the desired skill set and experience level. All of the things we've talked about up to this point also play into this employment challenge, right? I mean, providing your team members with the proper tools to perform and succeed translates to all of those efforts you put in with strengthening your job aids and reference guides, streamlining your processes, and really just optimizing each person's daily functions. So with all of these thoughts in mind, let's talk about what we can focus on to navigate through the next few months. First off, you can really enlighten yourself on a day in the life of your staff by spending some time shadowing their process, talking to them about what slows them down and looking at the allocation of everyone's responsibilities in your department. I'm sure a good majority of servicing managers and their team members would argue that they're understaffed, but senior management typically wants more concrete data to support the need for adds to staff. So how do you document and communicate these needs? One way would be considering an outside, unbiased source for an assessment of the operational process. Looking at staffing numbers and their current process often brings to light other opportunities for efficiencies, which could also make, working with what you got work for you. And perhaps most importantly, as you find new ways to address these current pain points, you help prevent burnouts and staff losses. It's equally important to take a look at your current operating procedures and what you have available for training and job aids. These are a crucial tool not only for your current staff, but also for onboarding new staff and cross-training efforts. Make sure they're up to date and that they follow along with the process and the systems you're operating on. I also would recommend conducting some internal audits ahead of your auditor's eyes, just to boost your confidence in what you'll deliver to them for review and ensure that everything is tightened up as it should be. And lastly, I would recommend reassessing your third-party vendors and the integration of automation to boost efficiencies and continue streamlining your workflow. These are services that you or your customers are paying for, and they should be working for you, making your job easier and alleviating manual intervention. You want to keep your focus on achieving that at all times. These types of actions are ones that we help guide our clients in setting up for every day, helping them prioritize, make sound decisions, and just solidify their operations and resources needed to achieve their personalized goals. We encourage you to set yourself up for success in all the same ways. And we would, of course, welcome an opportunity to assist you with that in any way that you see fit. At this point now, I'd like to pass this over to Rob Ellis, who will take us through the second part of our webinar today, sharing with us a compliance update on RESPA and Reg Z.
Thank you, Heather. Greetings, everyone, and thank you for joining. My name is Rob Ellis, and I'll be discussing two high-risk compliance items that are emerging as a direct result of the current industry trend of interest rates rising and pipelines drying up. It's during these times when lenders tend to go through what I like to call a creative phase to try and stretch rules, so to speak, in an attempt to attract more applicants and to compensate for these trends. And two areas that are highly susceptible to this phenomenon are the referral practices of lenders from outside sources, such as realtors, and trying to attract high-performing LOs with high-paying compensation agreements. Both are highly regulated, and today I'll be highlighting the general requirements of these items, as well as common pitfalls in complying, recent FDIC and CFPB exam findings, and discuss recommendations on how to avoid getting into hot water with regulators. So first, let's talk about referrals and what RESPA says and its requirements. Specifically, RESPA Section 8 prohibits giving or accepting a thing of value for the referral of settlement service business involving a federally related mortgage loan. And three things must be present for a RESPA Section 8 violation. One, there is the payment or acceptance of a fee, kickback, or thing of value. Two, there's an agreement to refer settlement services. And three, there's an actual referral. All three must occur for a violation, which is critical to remember and understand. The first element refers to a thing of value. And a thing of value is a broad term. Cash is obvious as one thing of value, but it could also be instances where a lender pays for another company's marketing or advertising services. The second element relates to whether there is an agreement to refer settlement service business. And an agreement does not need to be a formal or written agreement. In fact, it is rare to find written agreements to make referrals. It may be established by practice, pattern, or course of conduct. The third element refers to a referral. And a referral includes any action that has the effect of affirmatively influencing a person to select a particular settlement service provider. Important to note that the regulator's position on this third element is the customer doesn't technically need to go through with the selection for it to still be a referral. The influencing is enough for this third threshold. Now let's go through a real-life example concerning giveaways. But first, a question. Are gifts and promotional items allowed under RESPA Section 8? Well, it depends. Under RESPA, gifts and promotions generally are things of value and therefore could violate RESPA, depending on the circumstances. As outlined above, if the gifts or promotional items are given as part of an agreement or understanding for referral of settlement service business, and referrals occur, they are prohibited. And I've recently found violations in my reviews. For example, I did a review of a mortgage lender for RESPA and found an individual loan officer involved in a realtor giveaway contest program. The LO was sponsoring the realtors giveaway contest, which entailed customers and vendors having the opportunity to win prizes like gift cards for coffee and gift cards to places like Home Depot and Lowe's. The problem with the giveaway was it had 3 levels of prize giveaway tiers, and the prizes increased depending on the higher level tier that recipients could be in. The first tier was open to anyone, including vendors, and those prizes were a minimum amount. There wouldn't be a RESPA problem if it stopped there. But if a customer or vendor referred at least one referral a month, then they got moved to a second level tier where the prize values increased. And if a customer or vendor referred more than one a month, then they'd go to the third tier with the best prizes. Now, all this happened to be in writing on a realtor's website and clearly violated RESPA, as it contained all 3 thresholds for a violation. I also want to note that there's no exception to RESPA Section 8 solely based on the value of the gift or promotion. There's no de minimis, so even a $5 gift card will be an issue. Accordingly, you should carefully analyze whether providing gifts or opportunities to win prizes to referral sources could violate the prohibitions under RESPA. And this is very important because the penalties are rather harsh. RESPA allows for civil and criminal liability for violating the prohibition against kickback and unearned fees. The civil liability can be equal to 3 times the amount of any charge paid for such referral, and also the costs associated with any court proceedings with reasonable attorney fees could be recovered. But the biggest thing is an additional fine of up to $10,000 or imprisonment for up to 1 year, or both could occur. So this is one area you want to be sure is clean. Now let's get into recent exam findings. In a recent FDIC Consumer Compliance Supervisory Highlights publication, the FDIC continued to identify a RESPA violation at supervised institutions. These matters involve the payment of illegal kickbacks, disguised as above-market payments for illegal lead generations, marketing services, and office space or desk rentals. Examples of these violations were banks were paying for realtor expenses and marketing materials, and paying desk rentals at above-market rates. These things are easily detectable and prevented. So let's talk about mitigating risk. Number one, you should establish clear policies that clearly list allowable conduct and prohibited conduct. Number two, provide training to executives, senior management, marketing, and all staff involved in mortgage lending operations. Number three, perform due diligence when considering new third-party relationships entered into that generate leads or identify prospective mortgage borrowers. And number four, and this one is critical, develop a monitoring process for identifying, assessing, documenting, reporting risks to executive and senior management, and correcting violations ASAP. For further info on this subject, the CFPB has a blog page dedicated to RESPA Section 8, but also we here at SCA have programs to help review or implement those best practices, as well as conduct monitoring reviews for compliance with RESPA Section 8. Next up, loan originator compensation requirements under the Truth in Lending Act. The loan originator rule generally regulates how compensation is paid to a loan originator in most closed-end mortgage transactions. This includes prohibiting a loan originator's compensation from being based on the terms of the transaction or a proxy for a transaction term, and prohibits loan originators from being compensated by both the consumer and another person, such as a creditor. The LO rule also points out 7 permissible methods of compensating loan originators using bonuses, retirement plans, and other compensation plans that are based on mortgage-related profits. So when it comes to understanding loan originator compensation, it's critical to understand what the regulation defines as a transaction term. Some examples of transaction terms include, but not limited to, the interest rate, the APR, the collateral type, the existence of a prepayment penalty, the origination points or fees paid to the creditor or loan originator, fees for creditor-related title insurance, and varying compensation to loan originator based on the product type. That will violate the LO rule. All these items cannot be considered in compensation that is based on a single transaction or multiple transactions conducted by multiple loan originators. Some examples of prohibited compensation include, but are not limited to, an LO receiving higher compensation based on the transaction's interest rate, such as receiving 2% of the loan amount if the interest rate is above 6%, and 1% of the loan amount if the interest rate is 6% or less, or receiving compensation for closing more than 10 transactions per month with an interest rate higher than 6%. A loan originator receiving higher compensation based on whether a loan contract contains a prepayment penalty is also a violation. These are basic, but it's important to understand. So here's a question. Is the amount of credit extended a transaction term? Again, the answer is it depends. The CFPB has ruled that the amount of credit extended is not a transaction term if the loan originator compensation is based on a fixed percentage of the amount of credit extended. In addition, loan officer compensation may be subject to a minimum or maximum dollar amount, a floor or ceiling, so to speak, so long as the amounts do not vary with each transaction. For example, a creditor is permitted to compensate a loan originator 1% of the amount of credit extended for all loans originated, but that amount for each loan will not exceed $1,000 or greater than $5,000. I gave some examples above of the don'ts, but as mentioned previously, there are 7 permissible or safe compensation methods provided for under the rule. These compensation methods are effectively safe harbors, and compensation paid or received according to these methods is not based on transaction terms or proxies for the transaction terms. And they are, number 1, basing comp on the loan originator's overall dollar volume. Number 2, the long-term performance of the originator's loans. For example, early defaults. You could stipulate a clawback type of penalty if a loan goes bad within the first 3 to 6 months. Number 3, an hourly pay rate based on the actual number of hours worked. Number 4, to new customers versus loans to existing customers can be considered. So you can pay a higher comp on new business. Number 5, a payment that is fixed in advance for every loan the originator arranges for the creditor. Say, for example, $600 for every credit transaction arranged, regardless of loan size, and that stays fixed. Number 6, the percentage of the loan originator's applications that close. This can be incentive-based, for example, paying a bonus for achieving a higher tier percentage pull-through. And lastly, number 7, the quality of the loan originator's loan files. For example, accuracy and completeness of the loan documentation. Again, this can be an example of bonus-based or could be a negative hit. For example, a $50 hit if processing has to continually do extra work, like if HMDA data is consistently wrong. Again, these 7 are a safe harbor, which we like using, and some of this could give you an advantage to attract LOs, because I've not seen all of these being utilized in my reviews. Next up, let's go through recent exam findings. In its latest supervisory highlights report, the CFPB reports violations involving loan officer compensation. Examiners found that lenders' loan originator compensation agreements provided for higher compensation where Fannie Mae conforming fixed rate loans surpassed the designated threshold percentage of the total loans closed by the loan originator. This compensation was higher than the compensation paid when such percentage of loans did not surpass the threshold. The CFPB cited that paying higher commission under these circumstances violates the rule based on compensation on terms of the transaction, because in their view, products are simply a bundle of particular terms. The CFPB reported that as a result of these findings, lenders agreed to change their compensation plans to bring them into compliance with the loan originator rule. I want to highlight this is kind of a big thing, and you're going to want to review the LO comp agreements to make sure they don't differentiate based on product type, or else you could be cited. And finally, some ways to mitigate risk. Number 1, as always, a good rule of thumb is to establish clear policies that detail the precise compensation practices and identify everyone in the organization who is an LO. Number 2, document all compensation LOs to ensure compensation does not deviate from the established policies and procedures, and also to document for audit trail purposes. And number 3, I highly recommend reviewing periodically all LO comp contracts to ensure there's no compensation plans in violation of the rules before examiners do. And as always, SCA is ready to help with any of these aspects. Just reach out for a free consult on how we can help review or implement these best practices. Thank you, and back to you, Sean.
Thank you for joining us today. I hope you found this presentation helpful. If you missed anything, a recording of it will be sent out to all participants shortly after this is ended. And if you have any questions or would like to schedule a free consultation, please reach out to Bill Dolan, whose contact information is on your screen right now. Thank you.